In this session, let's start looking at the dividends and the share repurchases. What is the relationship that is existing between them? But before we discuss about the relationships between the two, we would also try to understand the various dividend based theories that are there, and we would look at the different taxations that are available on the dividends, and how do I compute the effective tax rate based on various tax systems on dividends. And then we would also look at different types of dividend payout policies that are there around the world, and move towards understanding the share repurchases, how the share repurchases are more better compared to dividend, or in what cases the share repurchases are better compared to dividend and vice versa. And finally, let's look at some metrics related to dividends and share repurchases which can evaluate the stability of the company. So these are some of the things that we would look at in this particular session. So let's get started into this aspect. So first, dealing with the theories relating to the dividend. So there are three key theories that we talk about. One is called as dividend irrelevance theory, as propounded by Modigliani and Miller. These are some of the proponents. Even these people have made exclusive or extraordinary start off in the area of capital structure also, wherein their focus was, in case of no taxes and no transaction costs, the capital structure was really irrelevant. Whether you maintain debt or equity, it is really irrelevant. Similar kind of a proposition they have brought in with respect to dividend also. In a world of no taxes and no transaction costs, even the dividend theory is irrelevant. Whatever the dividend policy the company is making, it is irrelevant as far as the investor is concerned, because if there are no taxes, if there are no transaction costs, the investor can create homemade dividend. What he says by homemade dividend is, let's say the company has declared a dividend of 3%, but the investor wants 5% as his income. What he could very well do is, he can sell off the remaining 2% of the shares. He can sell off 2% of the shares and create an additional 2% income. So, or if he thinks that the company has paid 10%, but he is expecting only 5%, with whatever the payment the company has done, extra 5%, he can use that money to purchase additional shares, which means virtually he is able to create his own dividend by either selling off his existing shares or buying of the new shares. But in reality, the buying and selling of these shares will result in transaction costs, and there would be gains. There would be taxes that could apply on capital gains. Because of these two things, whatever the homemade dividend that can be created will not be possible in reality. But what his proposition was, that is, look at it as a base. In case in a world there are no transaction costs and no taxes, the dividend theory is really irrelevant. Whatever the dividend the company is giving, it's of not much of a relevance, because the investor can create his or her own dividend by either selling or buying the shares. So because of that, there is no change in cost of capital, there is no change in the stock price, and even there is no change in the value of the firm. So there is complete utter irrelevance that is coming out by the dividend policy of the company. But because there are taxes and transaction costs, so a few more theories came into picture. One is called as a dividend preference theory. As the statement itself is saying, there is a preference to the dividend. There is some preference given to the dividend. And it is also in line with one of our old proverbs, a bird in hand is worth more than two in a bush. It's as good as saying, rather than thinking of something more uncertain future capital gains, let me focus more on some cash which I am getting immediately in the form of dividend. So, compared to a capital gain, individuals prefer dividends more as per this theory, because they are expecting, this is a certainty, dividend that they are getting, whatever is the money that they are getting, it's more certain, whereas whatever that you are going to receive in future, it all depends on the future performance of the company and how the market and economy and various underlying things perform, which means there is a lot of uncertainty about the future but more certainty for the current. So there is this theory is saying it's better to have the dividend more now rather than pushing something for the future. And whereas the third theory is tax aversion theory, which is simply saying investors will react based on how they are taxed. So, see, out of the profit the company is getting, we are talking of dividends as well as retained earnings. Retained earnings are coming as capital gains, or some portion which the company is paying is what is going as a dividend, and because it is retaining, that portion may result in increase in the stock price, which in a way is getting resulted as a part of the capital gain. So depending on how the taxes are applicable on dividends and capital gains, if the dividends are taxed more, it always goes with the investor that it's better to postpone my dividend. So he would be preferring a very less of dividend because he wants to avoid paying tax on the dividend that he is receiving. So the investor will prefer not to receive the dividend when the taxes are very, very high. So the tax aversion theory is simply bringing out the fact that the dividend policy of the company should be in line with the taxation policy also. So based on these three theories that are there, they are simply suggesting that higher the tax rates that are there in the country, there is a low preference for the dividends, and the companies, even the individual investors, prefer more and more of capital retention. But if the dividends tax on the dividend is going down, the demand for immediate declarations of the dividend and large dividend payouts will typically start picking up. Alright? Now, from the company's perspective, how is a change in the dividend? Let's say this year they have declared a dividend of $10 per share. Next year they wanted to declare $12, and the year next they are going to declare $8. Or probably in the last 3 years the companies have declared something like this per share. How is it perceived in the market? In general, what we observe is that dividend is generally perceived as a measure of the future potential earning of the firm. So higher the dividend, it indicates that the company has performed really well and it has the potential to perform well in the future. So even a small change, see again this reception of dividend or the perception of the dividend is different in different countries. In a country like US, even if there is a small change in the dividend, the people are very skeptical about it. If it is good, they see that the company has performed really extraordinary. If it is slightly down also, they see that the company did not perform well. But that is not the situation with many Asian countries. They don't react that badly for the changes in the dividend. But in general, also across the world, what we see is, if there is a dividend increase, there are two things that are typically looked at. One, performance is good, so that's where they have shared more and more dividend, so which is looked at as a positive signal. And on the other side, there are people who look at it as the company does not have sufficient reinvestment opportunities. No sufficient reinvestment opportunities, so that's where they are declaring and paying dividend, which is where they look at that particular declaration or increase in the dividends as a negative signal. So both of them could really come out as a part of increase in the dividend. But what is typically observed is whenever there is a decrease in the dividend, the signal generally is negative. So that's where the companies don't want to overcome it, because if in this year they have increased the dividend and immediate pressure comes on the company to declare similar levels of dividend even in the future, and if they have good opportunities for investing in the future and they are forced to pay a lesser dividend, it creates a negative vibe in the investor community. So that's where even if they have declared very good profit, and even if they have very sufficient cash flows, companies don't come forward to declare heavy dividends, or they don't want to experiment heavy changes in dividend, fearing on this particular factor, right? So any change in the dividend is definitely going to signal an immediate impact in the market and on the minds of the investors. So companies have to be very careful while playing around with their dividend policies, because there is a lot of information asymmetry. We have discussed about this earlier also. The managers versus the shareholders, the access to the information for them is completely different. Here, the company's performance, the shareholders, they have invested, but they are not a part of the day-to-day operations of the company. So there is the possibility of big information asymmetry. So that's where it's better that the companies maintain a dividend which is more stable or growing more stably, rather than fiddling around with it extraordinarily, because the investors react to it quite quickly, and more and more fluctuations in the dividend can send different kinds of signals into the market, right? So that is where we generally look at two major dimensions that are impacting the dividend payout. One, if I look at it from client's perspective, different clients have different preference for dividend. Why? Probably a very high income individual, he is already in the high tax bracket. So if dividend is coming to him in large volumes every year, even that dividend is also taxed at a very high interest rate, at a very high tax rate. So he is ending up losing more. So he prefers, it's better not to have dividend in this year, let me have it as a capital gain, and probably I'll take this capital gain sometime later when I really convert it into a gain. Probably in a year where I am not earning more, let me get the benefit out of it. So all these things are typically looked at as capital gains and long-term capital for those kind of individuals who operate in high income or high tax brackets, they prefer deferring of the dividend rather than receiving it earlier, because they will get the biggest tax benefit when they are drawing it in periods where their income is not that large. Probably after the retirement, when they are planning to pull it out, they are not going to lose on a big way on them. Similarly, if we are looking from a company standpoint also, companies which are thinking of paying low dividend, they should generally attract those customers who are not immediately looking out for heavy dividends, which means probably high net worth individuals who are already in the high tax bracket. So they would be the targets for the companies which are thinking of paying very low levels of dividend. The same way I can look at it the other way. Company which is planning to pay more and more dividend, the typical investors would be the ones who are looking at dividend as a source of monthly income or yearly income, and they are looking for companies which are paying more and more dividend because they are in the very low tax brackets. So the clientele and the composition of the clientele will have an impact on the dividend policy of the company. And the another interesting aspect is, let's say today the company has finalized one dividend payout structure, and they have finalized the portfolio on the composition of their different clients. After that, if the company is trying to fiddle with their dividend policy, the only thing is they are fiddling with the proportion of their clients. So let's say right now the company has one dividend policy, and this dividend policy attracted 20% high net worth, 30% moderate individuals or moderate income individuals, 40% of corporate, and 10% of low income individuals. Now, if the dividend policy is altered, let's say this company is going to move for very high dividend payout the next year, all that happens is probably the company will lose these customers. So probably this number will go down to 10% and it may gain more of these customers, which means it is actually playing with the proportions of the clientele rather than any additional value being added to the firm by changing the dividend structure. That is what is something that we need to be comfortable with. Once the company has established a dividend structure and it has finalized the proportion of its clients, any change to the dividend structure will only result in altering of the client proportions, but no extra value addition to the firm, right? Similarly, the other side what we need to look at, because whenever we talk about from an individual standpoint, any change in the price is purely looked at from the capital gain tax versus the tax on the dividend. If I am looking at some X amount of dividend and there is a tax of TD on the dividend versus there is a tax of TC on the capital gain, as long as the change in the dividend is equivalent to this, the individual is really indifferent to. There is no difference, but anything more or less, if the actual dividend or if the dividend change that the company is declaring is more or less, the clientele proportions will vary accordingly. The other dimension that we are looking at is from the agency issues. See, generally we talk about the agency costs associated between two sets of people. One is shareholders and management, and the other set of agency issues generally are observed between shareholders and bondholders. If we look at this, if I declare more dividend If the company declares more dividend, shareholders are very happy. If the company declares more dividend, the shareholders are more happy, which means the agency issues that are existing between these two parties can really come down, which can help the management to still focus on investing in a few negative NPV projects. So the shareholders' confidence in the management will grow up, which can result in the company picking up a few negative NPV or very low NPV project and can really get a real benefit out of implementation of those kind of projects. But on the other side, if the dividend payout is very high, it will have a big impact on the bondholders. So the dissatisfaction between the bondholders and the shareholders will actually increase. The gap between the bondholders and shareholders will increase, because bondholders perceive high dividend means the company is not retaining enough cash which can help for future growth, and if they can't grow in future, it is perceived by the bondholders that their future interest and principal payments are at stake. So they have a bigger worry in case the dividend payouts are more higher. So to avoid all these things, in general, the bond indenture, which is a kind of initial prospectus for the issue of the bonds, it should clearly identify all these provisions as to how much dividend can a company declare, or to what should be the maximum cap as far as the dividends are concerned during the bond maturity period, during the bond existence period. All these things have to be really looked at to avoid any kind of agency issues, because in general what we see is the bond investors view the declaration of a dividend as a transfer of wealth from them to the shareholders. So the dividend policy of the company should focus very heavily on the proportion of their clientele, along with the agency issues it is perceiving, and along with these two major areas, the focus is also on a few other factors. If at all the company thinks that it has large opportunities for investment in future, this could be based on the industry life cycle, the access to information which the company is having. Based on whatever reasons, if the company perceives that there are more and more investment opportunities in future, it's better to retain more and pay less dividend. So design a dividend policy where the payout percentages are not that high. If the company is perceiving that in the next few years there are going to be extraordinary opportunities for growth, it's better that the company plans its dividend policy accordingly. And at the same time, if there is an uncertainty in the future's earnings, okay, this year we have generated good profits, our net income is very high, but if I assume that in the next coming years, because of more competition or because of any other factors, I am expecting that the net income is not going to be as much as it is in the current year. Once it has created a high dividend because of high profit, the expectations in the future go up. And if any year the company is not able to meet those expectations, it will send negative signals to the investors. So from that perspective also, if at all the company is uncertain about the earnings in the future, it's better to retain more and more of dividend rather than retain more in the form of retained earnings rather than paying more in the form of dividend. So the dividend policy can be structured by looking at the uncertainty of the future earnings. And in case in 1 year the company has committed for a higher dividend because of higher profits, as I said, the expectations will go up, and every year the company will look forward the investors will look forward to the company to declare at least that much of dividend. And if in any 1 year, either because of more future opportunities or because of inability to generate higher profit, or for whatever reason the company is not able to pay a higher dividend, it immediately sends wrong signals into the market. So from that standpoint, in any 1 year, even if the company wants to pay more to the shareholders, it does show using a share repurchase mechanism rather than committing more on the dividend. And in some cases they could even give not a regular dividend, but it is they can give it as a special dividend. They will call it as a special dividend, pointing it to some special occasion rather than giving it as a part of a regular dividend itself, because the moment it goes as a part of a regular dividend, the expectations will go up. And on the other side, the dividend policy of the company should take into consideration the tax percentage prevalent in that country. So what is the tax rate on capital gains and what is the tax rate on the dividend? So if the dividends are taxed more and more, it is better from a company's perspective to have lesser proportion in the form of dividend compared to the retained earnings. So, and the other way, if at all the company is having so many tax exempted kind of investors, if the profile of the investors is falling mostly into the lower tax bracket or even no tax kind of a bracket, probably even if the company declares heavy dividends, it really doesn't impact the shareholders much. The other factor the company may have to look at is the issue of fresh equity, the flotation cost associated with it. If at all it has to raise fresh capital in the form of equity, even the access to that capital, the cost to that capital, all these things become very significant. So from that standpoint, it is perceived that it's better to go with internal capital, or it's better to retain the earnings or pay lesser dividend, wherein even if the interest rates are going up, there is a possibility of the external cost of capital will drastically go up. In that case also, it is better for the company to lesser the dividend and retain most of it for funding for the future growth, because that becomes more and more a favorable decision for the company. And in sometimes when the company has more volumes of bond investors also, the covenants with respect to the debt, the do's and don'ts of the company with respect to the debt, they also prevent the company from declaring abnormal dividends during a particular period. The availability of debt in the market, if the availability typically goes down, obviously the company has to depend more and more in the internal sources of capital itself. So even in those cases, the dividends will typically go down. So many factors are affecting the dividend policy of the company. So once the company takes into consideration all these factors, then only it can go forward in terms of proposing a dividend policy. All right. Now let's look at the different kinds of tax rates that are available in different countries as far as the dividends are concerned, and how do I compute the effective tax rate in each of the scenarios. So we have some countries where double taxation method is followed. In a double taxation method, at a corporate level there is a tax paid, and from whatever the money the investor is receiving, there is a tax that is paid by the individual also on the dividend. So let's assume, let's take one numerical, okay. Let's say the annual earnings of the company are 100 million and the corporate tax rate is 30%. So the net income, which is pre-tax income after the corporate tax, the net income of the company is 70 million. Let's assume that the dividend payout is 50%. So dividend payout is 35 million out of this. And out of this 35 million, the individual, he has to pay a 15% tax on it. So the tax that the individual is paying is 15% on this, taking it to 5.25 million. So whatever the individual is getting a benefit out of it is only to the extent of 29.75 million, right? Or if I look at it as instead of 50% dividend payout, 100% is dividend payout. So what is happening out of the 70, 15% means 10.5. 10.5 million is going out as a tax. If 10.5 million is going out as a tax, what is left to the individual is only 59.5 million. Means around 40.5 million is paid in the form of tax on the earnings. So the effective tax rate comes to 40.5%. The other way I can compute the effective tax rate in case of a double taxation system is whatever is the corporate tax rate. We have seen corporate tax rate is 30%, plus 1 minus corporate tax rate means whatever is reaching the individual after the corporate tax is paid. On that the individual is paying another 15%, resulting in the overall tax rate that he is paying is around 40.5%. Of course, company is paying 30%, and when it comes to the individual, he is paying 15% on it, overall resulting in 40.5% as the overall tax rate in case of a double taxation system. So there is another system called as the split rate taxation system, where the interesting thing is whatever the net income the company is generating, or whatever the pre-tax income, which is PBT, whatever the PBT, profit before tax, pre-tax income the company is generating, there are two levels to it, or whatever there are two levels to it. How much is paid in the form of dividend and how much is retained. Dividends are taxed at a different rate in terms of corporate tax, and retained earnings are taxed differently. So if I look at it like this, the corporate tax on the retained earnings is 35%, whereas on the dividends it is 25%. So out of the 100 million earnings, okay, if I say dividend payout is 50%, so 50 is retained earning and 50 is dividend, right? So tax wise on this 50, there is a tax rate of 25%. So 25% of this 50 giving rise to 37.5 million is actually left. 12.5 million is the tax. So 37.5 million is paid, and on the top of it the investor will be paying 15%. So in a way, if I have to look at the effective tax rate if I look at the effective tax rate in a split rate system, all I am doing is the formula is still the same: corporate tax rate plus 1 minus corporate tax rate into the individual tax rate. But the only difference being this corporate tax rate I will take as the rate only for the distributed dividends. I will not consider that particular tax rate that is applicable to the retained earnings. I will consider only the tax rate applicable to the distributed dividend. Then the third methodology that is available to compute of taxation that is available is the tax imputation system, wherein though the company is paying the tax, whatever the tax that the company has paid, it comes as a credit to the individual investor. Means everything, the taxation happens at an individual level. So whatever the tax the company has paid, it will come as a credit. So whatever is the balance as per the individual's tax bracket, whatever the balance that is there, he has to pay it, which means every individual or the effective tax rate is nothing but, in this kind of a mechanism, the effective tax rate is nothing but individual's tax bracket. So if the company has paid more than the individual's tax bracket, the individual can get a refund on it. If the company has paid lesser than the individual's tax bracket, he will have to pay the balance for it. Let's say a company has paid a corporate tax rate of 30%. If the individual's tax bracket is 20%, he will get a refund of 10%. Whereas if the individual's tax bracket is 40%, he will have to pay an additional 10% as far as that dividend amount is concerned. So in a way, the computation of the effective tax rate in case of imputation system is equivalent to the individual's tax bracket itself. Now, let's look at some of the key dividend policies that the companies typically get into, out of which one is a stable dividend policy. As the word itself is saying, the company wants to maintain a stability in the dividend. So what we talk about is whatever the dividend they are planning, it is based on how the company is expecting the long-term growth rate. So whatever is the dividend that it has declared today, it will first decide what is its target dividend payout ratio. So even though today it is paying lesser dividend than the target, within a few years it wants to come to this target dividend payout ratio. So gradually, year over year, it will keep increasing the dividend and reaches this target dividend payout ratio, and there is a stability in terms of the payout. So depends on what is the long-term growth rate of the company. So based on the long-term growth rate, it is assuming some proportion of a dividend payout and planning to reach that in some X number of years, and based on that it is trying to decide the payment of the dividend each of the years. That is what is a stable dividend policy. So what we are saying is the expected dividend is whatever is the previous dividend, last year's dividend. You look at how your EPS is going to grow, which is the growth rate in the EPS for this year, multiplied by whatever is your target payout ratio, and the adjustment factor, which is nothing but in how many years are you going to reach the target dividend payout number. So based on these things, you can compute the expected dividend for the next year. So for a company which is continuously profitable and rapidly growing, which is in the rapid growth phase of the industry life cycle, it's better to target this kind of stable dividend policy, so that the dividends will constantly keep increasing and touch a kind of a stable level in the long run. And on the other side, the companies can get into a constant payout model, which is nothing but the ratio is constant. If I am If the company says yes, 20% of 20% is our payout. If the EPS in this year is 100, so the dividend per share will be 20. If the EPS is 50, the dividend will become 10. So the dividend will be exactly in a constant proportion with the EPS. Because of this, what could very well happen is, if in a particular year the earnings are bad, the dividend can go down drastically. In a year when the earnings are really good, the dividends will grow up, which means there is a lot of volatility that can grow with the dividend. So because of which the valuation of that kind of a company will become more and more difficult, especially if the earnings are very largely volatile. There is a possibility that the dividends are also volatile, and hence the value of the company also becomes more and more volatile. So that has to be really worked out. Then the other dimension we are looking at, or the other methodology that we are looking at, is the residual dividend. Whatever is left out of what? Okay, from the net income which the company has generated in this year, find out how much capital is required for the next year. So based on the capital budgeting, find out how much capital is required for the next year. So whatever is the investment out of the next year, look at how much is in the form of debt and how much is in the form of equity. Based on the capital structure, you can decide that. And in this equity also, look at the cost of equity by borrowing, regarding the borrowing in the external market. So based on that, decide how much of retained earning will be used and how much of external capital. In general, retained earnings are looked at as a very good source, a very profitable source of financing compared to external equity. So based on the equity requirement for the next year, see how much has to be retained and let the remaining portion be declared as a dividend. So in this case also, there is a possibility of very high volatility in the dividend. The reason again being, if in a year the investment opportunities are more, the company can think of retaining more and giving less in the form of a dividend. Whereas if the investment opportunities are much lesser, it can declare more and more amounts in the form of dividend. So there is again a possibility of very high volatility, but if you look at it, it is very simple to operate. On the positive side, okay, I'm retaining whatever capital is required for the growth of my business. So whatever is left, I'll declare in the form of a dividend. But it sends a different signal in the minds of investors that they cannot value the firm quite comfortably because of the instability. There are some set of clients who look forward for a stable dividend, but if they are having more and more instability in the dividends, probably those clients are typically lost for the company. So though the residual dividend approach is more easier to calculate, it poses a few more challenges also which needs to be addressed by the policy makers. And one more dimension for the same is the long-term residual dividend model, which is an extension to this residual dividend itself, with the only exception that this capital budgeting, instead of being planned for the next 1 year, you plan it for a longer term, 5 to 10 years. So how much of capital is required for the next 5 to 10 years? And based on that, you allocate that capital more or less equally over the next 5 to 10 years, and based on that create your residual dividend, which means you will not have the situations of very high opportunities in 1 year and very low opportunities in the other year. You try to face the opportunities more or less equally across the period, and because of which the fluctuations in the dividend that you are trying to pay out may typically come down, and to a large extent stability in the dividends can very well come out through this approach. So this is one more dimension that the companies can typically look at. So basically we are talking of 4 different kinds of approaches here. One is a stable dividend, wherein we talk about a target payout ratio and reaching that target. Then we are looking at constant payout. Then we are looking at a residual dividend kind of a model and long-term residual dividend kind of a model. Each one has their own advantages and disadvantages, and it is heavily dependent on various other factors like clientele proportions and various other factors like taxations and the future investment opportunities. All these things playing a role in terms of deciding those dividend policies. So just looking at a couple of small calculations regarding the same. Okay, last year the company had an earnings of 4 per share and paid a 40 per share, and it has paid a dividend of 3 per share. So last year what was the dividend payout? It was about 3 out of 40. So almost only 7.5% is the dividend payout. Right? Only 7.5% is the dividend payout. Okay. Current year the company expects the EPS to be around 60. So if it is assuming the EPS to be 60 and it has said that the target payout ratio is 35%, and the target it has to reach in 5 years. It wants to reach the target in 5 years. So based on this, if the company has to identify how much the dividend it has to declare in the current year. So last year dividend was 3. Now what we are simply saying is, whatever the expected increase in the EPS. So the expected increase in the EPS is 20 now, right? The expected increase in the EPS is 20. From 40 they are expecting 60. So the expected increase in the EPS is 20. The target payout ratio is 35, and they want to achieve it in 5 more years, which is in other way saying it's better that they grow by 7% this year. So what is happening? 20, I am increasing it by 7%. So 20 into 7%, right, 0.07, it is working out to 1.4. So it's better that they declare a dividend of 4.4 this year. So 4.4 out of 60 will be slightly more than 7.5% itself. Whatever the dividend they have declared, 3, plus whatever is the increase in the EPS, multiply it with the target payout ratio, multiply it with the years. So 20 into 0.35 into 1 by 5, 20 into 0.07 working out to 1.4. So let there be a 1.4 excess in terms of dividend payout, making them touch the 4.4 per share as the dividend. And if I am looking at it, this is working out to 7 point some kind of a ratio itself. So this is how we are expecting. So initially probably it may fall, right? Here 7, 6, 46, 7, 4.2, 20, it has actually fallen to 7.3% itself, right? But over the period it will still keep growing. That is what is the intention in terms of moving towards a stable dividend kind of a model. Then look at the other one. A company has a capital budget of 3 million. Target capital structure is 30% debt and 70% equity. So which means 0.9 million it will raise in the form of debt, and 2.5 million it will raise in the form of equity. Net income will be 3.5 million. So out of that 2.1 million will be retained. So 1.4 million can be paid as a dividend. So dividend policy is 1.4 out of 3.5, resulting in a 40% dividend payout ratio. This is how I can use the residual approach to typically compute the proportion of the dividend. Now, the other side that I would like to look at is with that same benefit the company has generated, instead of paying dividend, it can buy back the shares, which is what is typically called as a share repurchase mechanism. So some of the situations where the company may prefer a share buyback over the dividend payment mechanism is especially if the gain on capital gain, if the tax on capital gains, if it is lesser than the dividend. So because the tax on the dividends is very, very high, the company typically does not want to declare more and more dividend because it does not favor its investors. So it will try to buy back the shares. Whosoever wants to surrender, they will surrender the shares, and because of that there could be a capital gain. But the capital gain is charged at a lesser tax compared to the dividend, so overall the investor is benefited. But if there is no difference in the taxes, if the dividend tax as well as capital gain tax, if the taxes are more or less same in for both the scenarios, then there is no impact on the value of the firm, and the investors are completely indifferent between the two mechanisms. So the tax, in case there is a tax advantage on capital gains, it makes more and more sense for the company to go for a share buyback rather than going for issuing of the dividends for the same amount. And because the number of equity shares go down because of the buyback, whereas the total earnings does not change, this will increase the price per share. The market value of the company does not change, but the number of outstanding shares is actually going down, which would result in the share price actually going up. So even that could be a bigger motivation for the company to go for share repurchase. And as we have discussed earlier, the company in a particular year where the cash flows are very high, instead of declaring a high dividend and getting caught in higher expectations for the future years, it can avoid that route by simply doing a share buyback and keep the dividends more or less sticky itself. So whosoever have surrendered, they get the benefit, and the share price for the others actually goes up, and they can very well avoid that pressure of paying more and more dividends in case of more profitable scenarios. And on the other side, that gives more flexibility to the company to give more and more employee stock option. Because if a company is giving more and more employee stock options, in case the employee exercises those options, they create more and more new shares in the company. So the number of shares, outstanding shares, will typically go up, and because of that dilution, the share price can actually come down. So the company can avoid that process by immediately trying to buy back some of the shares from the market if it has issued more and more of employee stock options. So it can balance both of them. While it is ready to issue new shares in the form of employee stock options, it is trying to buy back some of the existing shares using the share repurchase mechanism with the excess cash which it is having, and trying to balance the EPS as well as the overall market price per share. And because the equity is going down, various other ratios which are an indication of the performance effectiveness of the company in terms of return on equity, return on assets, all those will typically grow up. That's even a benefit from one of the dimensions. And whenever a management is thinking to buy back the shares from the investor community, it is strongly felt that the management is thinking that the stock is undervalued and that's the reason it is buying the stock. Sends very strong positive signals into the market. So management is really believing that it can do much more better in the future. So that's the reason it is trying to buy back the shares today at a much lesser price. So it sends very strong signals into the investor community that the current stock price is undervalued. And one more major thing is, at least when I compare it with the dividend, dividend is a forceful thing that is given to the individuals in terms of every person will get the dividend whether he is interested in it, whether he wants it or he doesn't want it. But whereas when it comes to the share repurchase, it is up to the investor. If he wants to surrender his shares, he can do it, otherwise he need not. So it goes as an option to the investor, whereas when we talk about the dividend, there is no option. It is mandatory for the investor to take the dividend once the company has declared. So from all these dimensions, I can very well look at a preference to the share repurchases over the dividends. And in general also, there are a few trends that are observed as far as the dividends are concerned. In general, the US companies give much lesser dividend compared to the European countries. And at the same time, over the last few years or few decades, there is a decreasing trend in the dividends and there is an increasing trend in the share repurchases. This is what are some of the observations that are done across the world, and in specifically comparison with US and the European countries. And as far as the metrics relating to the dividends are concerned, we look at a few dividend coverage ratios. There are two important ratios which we focus on. One is a dividend coverage ratio where we look at net income to dividend. Logically, I could have looked at the other way. Dividend to net income, this is what we call as a payout ratio. And 1 by payout ratio is actually what I call as a dividend coverage ratio. What it means is, okay, if the dividend payout is much lesser, dividend coverage will be much higher and vice versa. But the biggest thing that I have to understand is, if in a particular year the payout is high, so this will come down, no doubt about it. But if it comes down, if it is much lesser, right, let's say the dividend payout percentage is 20%, right, so the dividend coverage is 1 by 20%, which is 5. But let's say for the competitors the number is 8, 9, 10, something like that. Means they are paying the dividend, their payout ratios are not more than 10%. But this company has made a payout of 20%. Now, can it sustain that kind of a payout in future? So, if the dividend coverage ratio comes much lesser than the industry average, it is perceived that there might be a sustainability issue for the company to maintain that much proportion of the dividends in future. So the company has to really focus on maintaining the sustainability, otherwise it will send wrong signals into the market. Similarly, when we are talking about the free cash flow coverage also, the same thing. Instead of looking at the dividend alone, we are looking at the complete free cash flow that is available to the equity investors. I am looking at it as a proportion of dividend as well as share repurchases. Again the same thing, if I take the reversal of it, it is equivalent to the payout. So if the payout is higher, obviously this ratio will be lesser, and if it is much lesser, it's a question of sustainability. So these ratios, they don't talk about the proportion of the dividend the company is paying, but they deal more and more with the sustainability and the stability of the dividend that the company, can it really give that much of dividend each year. So if at all their dividend payout is much more than the industry average, there is a very high probability that they will cut down this dividend in the later period. So maintaining the same dividend levels will not be that easy in the future. So that is how I would look at the stability of the dividend metrics of the company. So these are some of the aspects as far as the dividends and share repurchases are concerned, different theories regarding the dividend, the different payout policies, and also the taxations on the dividends in different countries, and finally looking at the dividend coverage ratios. I hope all these things have given you a clarity into the understanding of the dividends and their structure. If you have any further queries regarding the same, you can get back to me by giving me a call at the number given below, 98480-12123, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.